Well, Ed, thanks for introducing yourself. My name is William Otis, and I am here with my ride or die partner, Mr. Aldo Anchetta, hailing all the way from Chattanooga, Tennessee. And so, yeah, we are excited to be here tonight and to be able to share with you. We are the co-founders of Stoke Holding Solutions. We've had our business now for just about a year. And we are, yeah, just itching to continue to grow. Just submitted an offer on a 144 unit, actually senior living property this past week. And so we're, that is actually our bread and butter. We are actually senior living guys. Collectively have about 25 years of experience in senior living in operations and asset management. I'm currently vice president of operations for a company based in Knoxville, and Aldo is our director of asset management. But we have a desire to do some things on our own and get out from get out from our W-2s and make real estate our number one. So we are working towards that, and of course also leaning into our senior living background. So we are, again, glad that you guys have joined us, and we want to get to know a little bit more about you. And I see some familiar faces. I see Mario here tonight. I see Mr. Johnson driving down there in Atlanta. So be safe down there, brother. And so anyway, yeah, feel free. If you'd like to introduce yourself, please take yourself off mute, and we'd love to get to know you a little bit more. And if not, then I will call on someone.
We got Bridget.
Hi.
We got Bridget.
All right, Bridget, let's go.
Hi, I am in the car, so it will be brief, but I'm Bridget Ruiz, and I'm from Southern California. This is maybe my third Zoom with you guys. I'm really looking forward to this particular this session. So thanks so much. And I'll probably have to go off video here while I drive.
Please do.
All right, thanks so much.
Yeah, be
Glad
safe.
you joined us.
Good to meet you, Bridget.
These Southern California people, there's just a few of them in these Zoom calls. So good deal. Awesome. David Rubarth, go ahead and take yourself off mute. If you have your camera on, I'm going to pick on you, which is a good thing. We want to see your faces. So David, tell us a little bit about yourself, sir.
Yes, I'm Southern California also, just like Bridget is. In fact, she and I had a call this morning, was really good. We actually connected last night on the call, which was really nice. And yeah,
Nice.
so we're
multiplying.
Huh?
I'm like, we're multiplying.
Yeah. So now we, we're looking forward to learning about this underwriting event and stuff too. So. Yeah, I'm a GC here in California. I do some fix and flips and want to get into doing some multifamily and stuff. And just a newbie, just like I said last night, but yeah, we'll get there.
Well, that's awesome, man. Well, welcome. Glad to have you. And that's what this is all about, right?
Yes, sir.
I mean, this is about connecting with other people, growing together, and just, being able to learn a little bit. And so I hope that tonight is helpful for you, and we're super glad to have you here. So with that, I'm going to turn it over to Aldo. And Aldo, tell us a little bit more about our community.
Yeah, absolutely. Thank you, Will. So, you hear in the activation Zoom and that we have basically the journey, we've, broken down the journey of Multifamily Freedom Chaser. And there's 3 different buckets that, we think people could fall under. And we know what we have to offer. And we also know that not everyone is a taker. So there's 3 different buckets. There's the no thanks bucket. There's the, hey, you guys are doing awesome stuff, but I have learned so much. And I know that I don't want to be a real estate investor. That's not what I want to do. I'm going to go chase freedom somewhere else. I'm going to go do my thing elsewhere. I'm going to own a business, or I'm going to do X, Y, or Z, and I'm going to chase freedom. And we're all about that. We're here for it. Go chase your freedom, however it is that you're going to chase it. Bucket 2 is, hey, you guys, I love the education you guys are giving me. You're teaching me how to not just underwrite, but know and understand this industry in a way that is helpful for me. However, I don't want to be a day-to-day operator, but what I will do is be a passive investor. Now I know how to look at deals and analyze them, and here's some money. I want to make some money without having to have all the headaches, and Ed will take it. So will we, by the way.
I asked first.
There you go. So there's that, the passive investor side, but you're getting good value out of these, and then of course there's the active operator. You say, I not only love this education, but I love the idea of operating a multifamily asset, right? Because there's of all the opportunities that lend themselves to this industry. So I want to be that, and I want to do that. And there is only so far that we as multifamily freedom chasers can take you, right? We're teaching you and showing you all the basics, all the core things that you need to know in order to have a good baseline before diving into this, right? So that's what we're here to do. That's what we're here to offer. So with that said, along the way, the Freedom Boys have made a lot of good relationships with many different people that are in the industry and that are paying it forward to those of us that are coming up, right? Through mentorship programs, through different softwares, and just all this knowledge combined and they're pouring it into not just the industry, but into our community itself. We've made a lot of really great relationships with the likes of Vina Jetty, Rod Khalif. There's so many more I'm forgetting.
Martinez, Robert Martinez.
Robert Martinez, yeah, the apartment king. There's a guy that worked for Grant Cardone as well, and a lot of people that have a lot of clout in this, and so we're here to kind of offer that to you guys as well at a discount. And so with that said, we have a MFC preferred partners, and these partners, they have just about over $2 billion in assets under management. So if you want to continue your growth, and by the way, we share our savings with you, right? So we give you part of all of the proceeds on this, so that it's exclusive pricing for the multifamily Freedom Chaser community, because we want you guys to grow alongside with us. And several of our community members or leaders have gone through these themselves, right? And so a little message from our very own Trevor about this program. So here we go.
Multifamily Freedom Chasers family, I have exciting news for you all. We are launching our Preferred Partners program for the community. You as a community member, as a Freedom Chaser, have access to this right now for free. So what is the Preferred Partners program? It is a program designed when you are ready to accelerate your multifamily real estate journey, you are ready to invest in yourself, to level up your education and business building experience. This is the place to go. These are the partners and resources that we have invested into and we use hands-on that have helped us level up in our multifamily journey. So pretty cool. Our preferred partners that are part of this list, it continues to grow, but right now they have over $2 billion of assets under management. Super cool. High-level teams and high-level operating individuals. So let me walk you through this here really quickly. We have Gabe Bowling's real estate training, Mastering Multifamily with Vina Jetty with her educational vault, Rockstar Capital and Robert Martinez, they have several different educational options. If you need mindset and performance coaching, we got Keston Glasgow with Purpose Ways. The Mirror Machine, website, funnels, marketing, everything you need there. Self-directed retirement services with Horizon Trust, CRM, an underwriting multifamily course with Ken Gee himself. And then if you don't have the funding, but you're ready to accelerate your multifamily journey and invest in yourself and invest in your business, we have DC Global Enterprises where you can get no interest funding to fund those type of investments. So take advantage of the Preferred Partners program of the Multifamily Freedom Chasers, and let's continue our chase for freedom together. Multifamily Freedom Chasers family,
Easy.
I have
sir. Easy now. Okay. Awesome. Yeah. So yeah, it was Gabe Bowling, by the way. So anyway, you see all the different programs that are available and the massive names that are pouring into our industry and into you guys, into this community. So take advantage of that. If you have any questions, please let us know. We'd be happy to direct you in that way. And then of course we have what we offer, right? The free education for you guys. We'll never charge you a dime for any of this. This is part of the community of who we are and what we do. And what we do like to do though is develop professionals and develop you guys within the community. As you can see, this started off with like the Sunday Zoom, and now there's 3, and there's even more people. You keep adding on and on and on and on. So we want to continue to encourage you guys to learn and then come back and invest back into the community so we can continue to grow organically and well. So on Sundays, we have our activation Zoom. We have the Freedom Boys, and they talk with, several celebrities really that are in the industry to get us activated for the week. And then of course we have our Monday broker talks with Billionaire Pete and Ed Shamirian himself. And they go over how to speak with brokers, how to get information from them, how to develop those relationships that are key to getting the deals you need, the deal flow that you need. Once you have your deals, then you bring them on over here to our napkin underwriting Zoom, where we can help you do a quick analysis of whether this is a good deal or not, and whether you can go and take it further into analysis. And then of course we have an alternating Wednesdays. We have the debt Zoom with the Miles family, and that's an incredibly useful Zoom for you guys to get into and go and see and understand what is happening in the debt market at the time. And then on alternating Wednesdays, we have the Multifamily Foundation Zoom with the Armada Group, and they've been doing an excellent job bringing in some of the core information about the general workings of this industry of multifamily investment. And so I recommend you guys jump on, and I believe we have one of those coming up tomorrow, if I'm not mistaken. I think the Miles family was last week. So with that said, we have a hand up. Benjamin, did you have a question, sir? Are you muted? I'm sorry, I can't hear you, brother. Okay. Man, you are, you're cutting out pretty bad, man. You're cutting out pretty bad.
I'll wait till later. I'm in a bad area.
Okay, yeah, that sounds
good in the chat.
Yeah, that sounds good. Yeah, he's driving though.
Oh, never mind.
Okay, yeah, great. Yeah, save your question for later. That's perfect. These are contact information, how you can get a hold of us if you have any questions around anything. It can be about underwriting, but it can be about anything else as well when it comes to multifamily investment. So please feel free to reach out to us in our email, or our Instagram handles are on the screen, as well as our telephone numbers. All right, so finally we get to the topic tonight, and we're gonna try to do this in 8 minutes or less, maybe more. Maybe we'll take a little bit more. Who knows? We'll see. So today we're talking about returns, but we're gonna keep it simple, right? Because this is napkin underwriting, and in fact, the napkin underwriting tool doesn't really account for returns, not as fully as it needs to in a full analysis. But these are the things that you need to be thinking about when you're underwriting a deal, right? So we napkin underwrite it to see if it has legs, and then we put it into the analyzer, or we fully underwrite it to really be comfortable and know what those returns could possibly look like, okay? Because a multifamily investment without returns is not a multifamily investment, right? So if you buy a property and it gives no returns either to you or to your investors, you're now blacklisted, man. You better have some returns, right? You could change your name, or you could go, maybe you can move out west to LA with Ed.
Our properties don't cash flow.
Where properties don't cash flow. That's right.
That's not funny.
So anyway, returns are important, right? And so there are three main return types that we look at, right? There's a bunch other more. There's so many more, but we're gonna keep it simple today, and we're gonna go at least over two, and then the third one I will mention because it's a little bit more complex, right? It's got some calculus behind it to calculate. And so those three are the following. Number one, cash on cash return. Put a 1 in the chat if you've heard of this term, cash on cash return. No, yeah, see, they don't cash flow out in out in LA, so Ed doesn't know what that is. Cash on, okay, Patrick knows what cash on cash is.
Is that the number
well,
always in red?
yeah. Well, do this. Patrick, if you don't mind coming on, tell us what is cash on cash return.
Uh-oh.
Yeah, I'm calling out. It's fine if you don't want to. It's fine if you don't want to. But I'd love to hear from you guys. They're like, that's what we're here for. We're here.
We scared all future participation in the chat.
Seriously. Okay, no, all good. So cash on cash. Okay. So we've talked about the revenue, we've talked about the expenses, and then we went over where the cash flow sits, right? At the very bottom of the P&L. After you take out the mortgage, any asset management fees, any capital expenditures or reserves that you're putting into reserves, you take all of that away and you have your cash flow, right? Cash flow. And so you take that number, and then you divide it into your initial investment. And you can do that on an annual basis, on a monthly basis, however you want to do that. The way that we typically do it is we calculate it on an annual basis. So for year one, let's say we invested our equity investment from the investor group was $1 million. And our cash flow, say for that year, was $40,000, right? So that is a 4%, check my math, that is a 4% cash on cash return, right? Because we put in this much cash, $1 million, and we got 40,000 back that year. So that is a 4% cash on cash return for that year. The next year, we continue our business plan, we increase our rates, we continue to hold our expenses tight, maybe we even get a little bit better at trimming our expenses or being more streamlined and efficient. And instead of $40,000 that following year, we make $100,000 in cash on cash return because we've been continuing to implement our business plan. Maybe we've increased occupancy as well as rents, and so now we're coming in 100,000. That is a 10% cash on cash return for that year two. All right, year three comes along, same thing. You continue to push your rates. Then we have 120. That's a 12% cash on cash return, so on and so forth. Let's say that continues, and that is of course assuming that you don't refinance your building and it doesn't make your mortgage payment any bigger, right? In addition to considering whether you have an interest only period in your initial loan as well, right? So these are just hypothetical numbers, right? If you continue on this trend. So through those 5 years, let's say that you have it held, you have, all of these different cash on cash returns, you then take an average of all of those, and that is your average cash on cash return, right? So you can oftentimes you start off like at a 4 because you just bought it and expenses go up that year one, but your rents don't go up right off the bat. And then you go from like maybe a 4% to a 6% to an 8% to a 12% cash on cash return. And it continues on and it averages out, say, to like a 9 or a 10 or an 8 or a 12% cash on cash return, average annual cash on cash return, right? So that's one metric that you can show your investors, that, hey, here's our average cash on cash return. Now they have to know that in the beginning, it won't be as much or maybe zero if it's an unstabilized community, look at me, senior living, unstabilized property. that is going to grow, right? So they have to know that. So that's one metric, right? A lot of people look at cash on cash, but it's not the only metric that's out there, right? Some people want to have a guaranteed return every year, every single year. And that's the type of investor that they are, right? And so that's that type of investor, and that's a good metric for them. Another return type that we look at quite a bit is called the equity multiplier. Now, by the way, I'm going to just give Victor a quick plug here. One of our very first Zooms on underwriting, Victor went over these in pretty good in depth. And so feel free to go back into our YouTube channel, and feel free to drop that in the chat as well, and check out those underwriting classes by our very own underwriting ninja, Victor into the G. So anyway, the equity multiplier is essentially the total return. So then you take not only the cash flow happening from your operations, but the cash also that comes in through a refinance and or a sale of the property. You take all of those cash or inflows of cash, and then you compare that to your initial investment, right? So essentially it's you divide all of these cash flows into your initial investment, right? So for example, and it's shown as a multiplier, right? So it's like a 1.5x or a 2x, etc., right? So an example, same thing, you put in $1 million, or the equity pool is $1 million into this deal, right? All of your cash flows after your yearly cash flow and your refi and your sale, you put all that together and you clear another, say, $2 million, right? So if you clear $2 million, that is a 2x equity multiplier, because you're getting 2x return on your money, right? That's over the 5 years, which means what? People have put in $1 million. After you clear $2 million, you return the equity, you return the $1 million equity, and then you have the other $1 million equity for the whole deal. And that is a 2 times equity multiplier. That is something really good to show your investors and say, hey, look, our cash on cash might be a little bit low, maybe lower than you would like to see. Maybe it's at a 5 or a 6, but this is a value at play. We know that we're going to grow occupancy and rents by year X, and by this year we're going to refi, and we know, or we don't, so we believe based on market conditions that we can get this much out of it on a refinance or on a sale, right? And so we can say we won't offer you a 12% annual return, but we're going to offer you 2 times your money. You're going to double your money with us in 3 to 5 years, right? Some people really like to hear that, because they may not need the returns right now, but they want to not only put their money somewhere that is safe, but they want it to make some money as well. If you put that elsewhere, if you put that anywhere else, it may only make like 4, 6, 8% return on their investment, right? When on a 5-year time frame, if you double your money, that's about a 20% return, on your a year on your investment. Which leads me then to my next metric, which is the IRR. That is the internal rate of return. Does anybody know or have who has heard? I'm not going to ask you to say if you know what it is or can explain it. Who has heard of the term IRR? Internal rate of return. There you go. Mario has heard of it. Who else? Yep. Okay. IRR. That's a big one. That's a big one out there, right? Because it takes into consideration different things, right? It takes into consideration your annual cash flows. It takes into consideration the cash inflows from refis and sales, etc. And it takes into consideration time as well. All of those things together, right? So the reason I said, and I know that a 2x return in 5 years is 20% a year, is basically because you're getting 20% every single year. That adds up to 100%, right? So you're making 100% over your money. And so, but if it was 6 years, it would be less. If it was 3 years, it would be more, right? So it takes into consideration the time, right? So that is an equalizer. This return is an equalizer of all the other returns. And you can see here, and you can show an investor, okay, see our cash on cash is low. Maybe our equity multiple is high. But here's the real equalizer. In 5 years, your returns per year are going to be this much, right? So it's the internal rate of return, what return I'm getting for my money in total, considering time. Okay. Is that clear as mud? Great. All right. What questions do you have on any of these returns?
While people are thinking of questions, I can add something real quick.
Yeah, for sure.
One of the biggest hesitations, and why you guys will hear, like, you always want to be as accurate as possible, but one hesitation with raising more capital or needing more capital up front, cash on cash is a direct correlation to how much cash you have initially invested, whether it's down payment, whether it's rehab, whether it's cost, fees, X, Y, Z, doesn't matter. At the end of the day, that is why you want to keep your investment initially into the deal as low as possible, but without over leveraging. It's that fine balancing act between I have too much debt, which is how that one big Houston property portfolio that went under, which was causing a lot of issues earlier this year. That's how they got kind of screwed, was they're over leveraged. But also you don't want to have to raise too much capital toward the cash on cash. Doesn't make sense. So that is where understanding, and this is a little more than just a napkin underwrite, which is why we don't have it on there, but it is very important to understand like the correlation between the two. And to kind of like bring it back home with the returns and why these are so important is every investor is looking for something different. No one cares about one thing only or the other thing or all of them equally. That's just not how it works. So it's important to know, like, what do my investors care about, and do I have an answer for them when they ask about what this is? Because one person may care about cash on cash, the other one's like, what am I getting in 5 years? Like, what metric do they care about? That's very important to understand and be able to explain. I think that's kind of up there, obviously, in priority as well. So keep all that in mind. Aldo, thanks for explaining all that. That was great. But yeah, it's like a lot of factors that go into it. And you want to make sure that regarding your returns overall, don't be so safe it hurts, but don't be so optimistic you're stretching the numbers. That's important too. Like, I'm trying to get to 20, so maybe I could get a little more rent, or maybe I can lower these expenses. Try to be as safe as you can. Under promise, over deliver is the best thing you can do for an investor.
Absolutely. No, you make an excellent point. And we have a question here, and it's a great question. With regard to IRR versus monthly cash flow, how do you address that with investors to manage their expectations? For example, you project 6% return, but you're only able to provide a 4% for a period of time. That's a great question, right? So how do you do that? Well, you're honest about it. For me, I would show my investors my underwriting. I would show them how I got to where I got. I would show them that, hey, year 1 or 2, it's going to be lower than the average. And here's why. And here's what we're going to do to mitigate that. So, so for example, say, and that's why we don't offer a pref. That's why we're not offering a pref, because you're going to not only, make your money here, but we're going to make even more than what we're promising here. If, obviously if you operate things right. And so I think you just be honest and you be transparent about what you're doing, and you're going to attract the right investors, right? And so it's also important to know your investor, like what Ed was saying, because some people might just want, hey, I don't care about a massive equity multiple. It might be a 1.3, 1.4, whatever. But hey, I'm getting good, annual returns. Maybe I'm getting like 6-7% of my money on a class A asset. That is, a much safer bet than a C class, value add bet, right? And some people want it, the other way around. So the C class people, they've got to know and understand that the first year or two, you're implementing a business plan, and you may not get the returns you want. In fact, you may have to raise what's called working capital so that you can meet the demands of your operations, because you would be under that year, right? So you have to budget for any negative cash flows that you may have, right? Based on your business plan. So I hope that was helpful. Definitely, yeah, definitely be transparent with your investors.
And also regarding that, it's Aldo mentioned this too earlier. Unless you're buying something that's stabilized and you're just parking money and you want the depreciation, or you think you can increase rents without doing much rehab, and you're gonna have some turnover, but not a crazy amount. You're usually gonna have a bit of an uphill battle the first year. What I mean by that is you're most likely turning the most units, you're spending the most money, you're doing the most rehab, you're all hands on deck, and you have a lot of turning units, so you're gonna have a lot more less stability and also a lot less returns year one. Any investor has to know that. The idea is that you're projecting the return over an average length of time during the life of the deal, and also making sure that you are on to all those points, like very upfront. And in the pitch deck, you're gonna go into a lot of these details. You're gonna say, hey, this is the plan year one, year two, year 3, 4, 5, and this is the outlook we have, and it'll really lay out what that strategy looks like. And investors know, like, it's not like I'm getting these returns day one. And to another point, your GPT may not get much of the cash flow if any of the returns year one. I'm not saying you're paying out of your pocket, but you may not be getting those returns, or that, let's say it's an 80-20 split. Well, once you save 20% off of the jump, like let's say that first year, it allows for more leverage and room and kind of favoring the investors. Like, I'm not saying you suggest to do that every time, but hey, if you haven't invested money into this, not getting anything the first year is not the end of the world. To be fair, you have that buffer in there. So as long as your investors are happy, they're making the returns they want, and the deal still makes sense for everyone, and you're not paying out of your pocket or bleeding the money, like, you'll be okay,
That's right. Okay. Ask questions come in. Oh, Ben, yeah. Go for it, Ben.
Hey, how about now? Is this good? Is this good?
Yes, sir.
So I just want to add to what you guys were saying. As a passive investor, even after I invested in the deal, the monthly communications that I'm getting from the GP team make a world of difference from some other people that I've heard who haven't got regular communication. So if the deal is doing well, or if it's not doing well at all, we're informed. And so that's going to help you with your investors when you set that expectation up front based on what the guys just told you, as well as what you do once the deal closes and you're communicating with them on a regular basis. I wanted to throw that in there. And then I have two questions. The first question is the preferred partners that you guys were talking about earlier. Since I'm driving, I couldn't really see anything. I presume that's on the web. That's on the website. I can get that information from there.
Correct.
Yes, sir. Yes, sir.
Okay.
Is there a link? Yeah, it's so it will be on the MFC website, and maybe we can throw a link on there for you guys as well.
Okay, that'd be great, because I get the text messages about the weekly calls on the different days. Mm-hmm. So whether it's there or you put it in the chat, I'll just have to pull over and get to it before the chat disappears. So that's cool. My other question is, do you have any of your YouTube recordings that addresses a complete lease up? I have a potential partner in Atlanta who's looking for like D class where they're basically all vacant or mostly vacant. And I just wanted to know if you had any underwriting recordings that address the property like that.
We do not have anything specifically underwriting, say, a full lease up. So like, from the ground up, essentially.
Okay.
but there are some tools out there. And you can do it. You can do it with a regular analyzer. Just the only thing, and I learned this recently, is you have to mitigate for rent growth or occupancy growth year over year. Right?
Yeah, because
month over month. We don't have
Okay.
anything specific like that in our YouTube. So yeah, that's a really good question.
Okay, thanks. Yeah, because I've tried to use yours and a couple of other ones to do a complete lease up, and it gets a little wonky because most of ours are geared towards properties that are stabilized or close to being stabilized. So,
Right. It's an acquisition.
Okay.
It's an acquisition calculator. Yeah.
Yeah.
Not a
Okay.
new build or lease up. Yeah, calculator. Yeah.
Okay.
Let me think on that a bit, man. Maybe I can find a little something there that could help you with a lease up. Unless Victor, unless you have any suggestions for that.
I don't have anything at the moment. Really, that's when you have to understand what your buy box is. That's not something that we currently are looking at. So we don't have too much resources about that.
Yep.
Okay. No problem. I appreciate it. Thanks, guys.
Awesome. Thanks, Ben. Sweet. We've got about 15 minutes, so I think Will's been able to get us some deals to underwrite. So have we gotten any further details on that?
Not yet, but I think Mr. McLeod has, he was the first one. So
Peter sent
Joel,
us one.
you wanna take-
in case we need one.
What's that, Ed?
Peter sent us one too. He emailed it to you and I if we need one.
Oh, okay, good.
yeah, I think we have about 3 people. So is Mr. McLeod, is he still in here? Is Joel still on?
Joel, you on here? You want to go through your deal?
If not,
All right.
then we will go to Barbara.
Okay, Miss Barbara. Do you want to go over your deal?
Feel free to take yourself off mute.
Oh, I didn't know I said that, but
Oh,
sure.
okay. Okay.
Yeah, I got it right here. So I've not been on your call where you guys do this. So how do you want me to go through
Okay,
it?
yeah, great, awesome, perfect, yes. So basically, we do a few inputs into the calculator, and it'll, we'll go over the results and kind of what they mean, right? So the things that I need here are the average rents, total average rents for
Okay,
everything, average rents if you have that, total units,
okay,
occupancy, and the asking price, basically the whisper or suggested price.
okay. So total units is 288. Asking is we'll call it 34 million. I think they'll go in less than that. 288. I'm sorry. I'm looking for the average rent. I picked this up from somebody else. I believe it is $12.92.
Okay. And the occupancy?
The occupancy is got different numbers from them, so I'm a little.
Don't you love that? Like 3 different places with 3 different occupancies.
Yeah, you see it different ways. I'm gonna call it 92%.
Okay. Great. So, are they telling you kind of what the market rents could go up to?
13 conservatively. Gotta look at my underwriting. I'm sorry. Just curious what you guys they're gonna come up with here. 1388.
And what class asset is this?
It's a B.
It's a B class, okay. And general area. No need to get specific. Is it in the southeast? Is it?
It's in Texas.
It's in Texas, okay.
Big enough state I can.
Yeah. No. Just to kind of get an idea of like
Mhm.
what cap rates, valuation, and that sort of thing are as well. So are you familiar with the market cap rates in that area?
Yeah, so they're going at, I believe they're going on this one at 5.5.
Okay. Well, it's,
Um,
so that makes sense on the B class. So as far as debt is concerned, I didn't say this that you needed this one, but this will play into it. Do you have a debt quote at all, or
I had a debt conversation. Let's do it
Okay.
like that. The
okay?
debt conversation is with a couple different people is around 20 million, 6.25, 6.5.
Okay, 6.25, 6.5. Wow, that's pretty good. We'll go 6.5. We'll go 6.5.
What I was using. So.
And I've got you a 65 LTV coming in at 22 million on a 30-year. Now, if you're at 92%, this could be picked up by agency debt. I don't know if that's who you talk to, an agency
He
broker.
gave me a couple different thoughts. One was if he could only get us to 18 million, then using some private.
Yeah.
If he called it private or preferred. And then if he could only get it to 18 million, the reason they're selling it is because they're in trouble on their debt.
So they owe a bit.
Yeah, and their rates just sliding right up the scale, so.
They might need to write you a check to get rid of it. So 60% LTV coming in at 20 million, like you were mentioning.
Yeah, 60% is,
Yeah,
that's
we'll
where.
keep it right here. All right, so at 1292, average rents 288 units, occupancy at 92%. We're gonna assume a 50% expense ratio on a B class. Well, which is pretty standard, I would say. NOI coming in around 2 million, 2.05. Is that about what they're showing? They might be showing a little bit more based on if they have other income like pet fees, etc. It might be more.
Their NOI is, why did it not print? Hang on a second. I like to work off of
And that's okay.
actual piece of paper. Nope, I have it. It's here on my spreadsheet. Yeah, they have their NOI coming in at 941,000.
Oh wow.
Now, if I do the 3-month annualized, I get it to 1.595.
Yeah, so annualized NOI, a T12 NOI.
Yeah, no, their 12-month
12
is
months,
941,295. But if I do the T3 and annualize it, then I'm at like 1.6.
So is there current occupancy? What if you do a T1? What if you do just a 1 month annualized NOI?
I need a second to do that.
What's their last and their latest month?
Their 1 month is hang on, it was 120,393 equals that times
1.4, yeah, 1.45 or so, which doesn't get it anywhere near close to that. So something's going on there. So there's
yeah, they've got all this bad debt.
Yeah.
They've got this massive amount of bad debt. They've got, for the 12 months, they had a 370,000 vacancy loss and 158,000 loss to
Yeah.
lease.
Woo. Yeah, so man, so their economic occupancy is probably down in the dumps, like low
And
80.
well, and then they have a 400,000 bad debt write-off.
Yeah. This asset's nowhere near $34 million. Woo. All right, but for the sake of this exercise, we will pretend like you know, these numbers match what they're saying and doing, right? So at an average of almost $1,300 a unit for 288 units at 92% occupancy, we're coming up with basically $2.05 million NOI, right? So if we paid $34 million for this, our cap rate at purchase would be 6%, which already beats the market, right? If they were actually performing to this level, I would say this is a deal you buy all day long, especially with, well, maybe not all day long because your debt is a little bit higher.
Because my debt's higher than my cap, yeah.
So you're under leverage, right? So you could, you know, argue for a little bit less here and try to get it down to maybe match, or maybe just go up to a 7 going in cap. Especially if they're in trouble, they might, you know.
Oh, they've got to sell this thing.
Yeah, so, you know, maybe this is a 30 million deal. Or maybe less, 29 million. So anyway, what you're doing here is you're playing around with the offer price so that your cap rate when you purchase it, you know, kind of matches your interest rate. Now this is cap rate at purchase. This isn't what is called a going in cap rate, which is your cap rate after year 1 of operations, right? Your year 1 cap rate. Well, let's make sure we change this average rent. So in year 1, let's say we move up average rents by $50, we get it to $1,342, and we'll keep the occupancy the same. Yeah, 29 million brings us to a going in cap rate after year 1 of operations at 7.36, right? So this could be a $30 million deal, let's say. Yeah, it's, you know, I feel comfortable kind of getting around that.
Okay. Can I just ask one other question? There's something on here I haven't seen back, and I don't know what to do with it.
Okay.
They're using lease lock. Are you familiar with lease lock?
I've heard the term, but I'm not super familiar. Ed, are you familiar with lease lock? You're from that area of lease locks.
I actually haven't much. Did they
Okay.
say anything else about it? Like context wise?
So I started to look it up because the numbers are big on the sheet. So apparently what it is instead of collecting security deposits, the tenants pay into this insurance policy.
Okay.
So in the case where you have damages, they didn't pay their rent, this is that their website is not clear at all. So I'm guessing what this is you go, instead of saying, oh, tenant, I'm keeping your $1,500 security, you go to this policy.
And they pay into an insurance, and then if they have to fix the apartment, then they take the money from that. Okay.
Yep.
That makes sense.
The numbers on here, you've got a bad debt recovery through lease lock, then you've got another bad debt recovery, then you've got the fee from this that they collected through this, and then you've got the fee that you pay. So I'm thinking about on a separate underwriting, just pulling all of that out, because I think it's skewing the numbers.
Okay.
Is that how you might handle that?
That's the first time I've heard of that lease lock. So
Okay, that's fine. I thought I was missing something because I
think it's always a good fundamental to underwrite to actuals and to what you know you can get. Right. And it sounds like if it's going into a policy that it's not going into your pocket. That would be my assumption. right? Unless you're the one that's creating this policy. And it's just going,
Okay.
right?
I don't know. I'm gonna have to ask the broker if he even knows anything about it.
My
Yeah.
biggest concern with this is anytime money is going into something that's not in your control, is it easy to get out?
Right.
And how tight are you to, like, not say always, but there's like, anytime you want to access anything like a reserve or insurance, whatever it is, justify, explain it, wait for it, front the money. It just, you're spinning in circles at that point. Yeah, I would contact the broker or what you said. This is in Texas.
Mm.
Maybe
But
property management company will have a better idea of how to tackle that.
Okay, a management company that I contacted, he's actually gonna underwrite the property for me as well. So maybe he's familiar with it.
Yeah, the tough part about this is the economic occupancy, right? All the
Right.
all the giant, write-off that just happened, and they might be doing that to get it turned around to sell.
Right.
So I don't know. Maybe someone with deep pockets can go in on a $30 million deal like this, but it doesn't seem like it's worth it at this economic occupancy, right? Even though there's heads and beds, I guess. But
Right.
definitely get your broker to do that. So great. So that's that part of the
That's how you would
calculator.
do it. Perfect.
Yeah, that's how you would do it. And the other side kind of gives you a rough estimate of what your upside could look like based on how much you drive rents and how much you drive your occupancy, etc. And then, you have a small calculation here for your returns on year one of operations and when it's stable at the stabilized occupancy and average rent number. So just super rough numbers, by the way. I know we talked about returns today. So anyway, this was great.
That's awesome. Thank you so much.
Absolutely. Ed, can you drop the calculator into the chat as well for
Yep.
everybody to use? And so yeah, guys, this was great. Did you guys get some value out of today? I hope you did. And if you don't mind telling us what other topics you want to discuss, we have a list, of course, of topics that we cover. But if there's anything that you want to see, we'd love to talk to you about it and teach you a little bit more. So awesome. Hey, thanks for being here tonight with us, and for all of you who participated. This is always one of my favorite times of the week to get to hang out with you guys, and we can all learn a little something like lease locks today. I learned about lease locks. Thank you for that. So anyway, hey guys, until next time, I'm going to send you out with some Viva La Vida. So have a great rest of your night and great rest of your week. And make sure you jump on tomorrow night with the Armada group.